A. Build, maintain, and review relationships with external financial service providers. Building strong relationships with external financial service providers is a critical treasury responsibility because organizations rely on banks, investment firms, payment processors, insurers, and advisory institutions to support financial operations and strategic objectives. Treasury professionals establish partnerships with providers that offer services including cash management, financing, investments, foreign exchange, merchant services, and risk management solutions. Effective relationship management improves service quality, enhances access to liquidity, and supports operational efficiency. Treasury teams evaluate providers based on financial strength, industry expertise, technology capabilities, pricing competitiveness, geographic coverage, and responsiveness. Strong provider relationships also improve communication during market disruptions or operational challenges. Treasury professionals must align service provider capabilities with organizational goals, risk tolerance, and long-term treasury management strategies to support sustainable financial performance. Maintaining relationships with external financial service providers requires continuous communication, performance monitoring, and strategic collaboration. Treasury professionals regularly engage with banking partners and other providers to discuss operational needs, market developments, financing opportunities, and emerging risks. Open communication strengthens trust and allows providers to better understand the organization's liquidity requirements, transaction volumes, and growth objectives. Treasury teams review service-level performance, transaction accuracy, system reliability, and customer support responsiveness to ensure providers continue meeting expectations. Strong relationships also improve access to specialized financial products, market intelligence, and customized solutions that support treasury operations. Consistent interaction with providers enables treasury professionals to negotiate favorable pricing, improve operational efficiency, and maintain reliable financial support during changing business conditions. Treasury professionals must periodically review external financial service provider relationships to ensure services remain competitive, efficient, and aligned with organizational needs. Reviews typically include analysis of pricing structures, banking fees, credit availability, technology integration, operational reliability, and overall service quality. Treasury teams often use scorecards, benchmarking studies, and request for proposal processes to compare providers and identify opportunities for improvement. Market conditions, organizational growth, mergers, acquisitions, or technology changes may require adjustments to existing provider relationships. Treasury professionals also assess concentration risk because over-reliance on a single provider may increase operational or financial vulnerability. Regular relationship reviews help organizations optimize provider selection, strengthen operational resilience, and maintain effective treasury support across multiple financial activities. Risk management is an essential component of external provider relationship oversight because financial institutions and service providers expose organizations to operational, credit, cybersecurity, and reputational risks. Treasury professionals evaluate provider financial stability, regulatory compliance, cybersecurity controls, disaster recovery capabilities, and internal governance structures before establishing or renewing relationships. Monitoring counterparty creditworthiness is especially important when providers support investments, derivatives, or large-scale liquidity management activities. Treasury teams also assess service continuity risks associated with technology failures, fraud incidents, geopolitical instability, or regulatory changes. Strong due diligence processes and ongoing monitoring help organizations identify emerging concerns and reduce exposure to operational disruptions. Effective risk management strengthens confidence in provider relationships and supports stable treasury operations during uncertain market conditions. Technology integration and operational compatibility are increasingly important factors in managing relationships with external financial service providers. Treasury professionals evaluate providers' electronic banking platforms, treasury management system compatibility, reporting capabilities, payment processing tools, and cybersecurity standards to support efficient operations. Automated connectivity between internal systems and external providers improves cash visibility, reconciliation accuracy, transaction processing speed, and financial reporting efficiency. Treasury teams also coordinate system implementation projects, testing procedures, and communication protocols with providers to ensure smooth operational integration. As financial technology evolves, organizations expect providers to offer innovative solutions that improve automation, data analytics, and risk management capabilities. Effective technology collaboration enhances treasury performance and supports scalable financial operations across global organizations. From a CTP examination perspective, candidates must understand the strategic importance of building, maintaining, and reviewing relationships with external financial service providers. Exam questions frequently assess the ability to evaluate provider performance, analyze banking relationships, identify operational risks, and recommend provider selection strategies. Candidates should understand relationship management principles, provider evaluation criteria, fee analysis, technology integration considerations, and counterparty risk management practices. Knowledge of service-level agreements, request for proposal processes, operational controls, and market benchmarking is also important for Treasury decision-making. Treasury professionals must recognize how strong provider relationships support liquidity management, operational efficiency, and organizational financial stability. Mastery of these concepts enables Treasury professionals to manage external partnerships effectively and support long-term Treasury objectives.